This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hi everyone and welcome back to the channel. If you've been following the high dividend ETF community, you're probably already aware that BMO is launching their target cash flow products, the new .T series. Now, these are fundamentally different from the covered call ETFs we usually talk about. A standard covered call ETF generates distributions by selling covered calls and collecting premiums. However, BMO's target cash flow series operates on a different logic. It returns a portion of your principal or return of capital to meet a specific payout goal. There are two main scenarios here. First, we have the series where the underlying asset is already a covered call ETF. Take ZWEN or ZWK as examples. These already have respectable yields, but the target cash flow units set a distribution goal that is higher than the original yield. Any shortfall is simply made up by returning a portion of the capital. The second scenario involves underlying assets that are not covered call ETFs at all, like ZEQT.T, ZGRO, or ZBAL. These typically have very low internal yields, usually between 1% and 3%. But because their .T versions target a 6% payout, the remaining gap is filled by returning capital. The big question is returning capital always a bad thing? Is it possible to receive these payouts while your net asset value continues to grow? Let's break it down in this video. Let's look at a concrete example. ZWB, BMO's Canadian Bank's covered call ETF. This is the parent of ZWB.T. Since it has a 15-year track record, the data is very reliable. ZWB itself has a yield of 5.68%. But the ZWB.T version targets a 13% annual payout. If we look at ZWB's historical total return with distributions reinvested, it averages about 10% per year. Herein lies the problem. If you're taking out 13% in cash flow but the asset only grows by 10%, the math simply doesn't add up for the long term. Your principal will inevitably erode over time. However, I've crunched the numbers, and there are several products in BMO's new lineup where the growth actually outpaces the target payout. These include ZEQT.T, ZGRO.T, ZBAL.T, ZWEN.T, ZWG.T, and ZWT.T. Let's look closer at a few. First, ZWEN, the energy covered call ETF. Its total return is 14.2%, while the .T version targets 13%. Based on the data, it is sustainable and should keep the NAV relatively stable, but because the record is not long enough, it will need more data to find out. Then there's ZWG.T, the gold covered call ETF. Its target is 10%. While the data shows a staggering 51.87% annual return, keep in mind this ETF only launched in 2025 and caught a massive gold bull run. Honestly, that's not a very reliable benchmark for the long term. The one that really stands out is ZWT, the technology covered call ETF. The underlying yield is 5.26%, but its average annual return has been 18.02%. The .T version targets an 11% payout. This means if the tech bull market continues, the growth can easily cover the payout, and your NAV could even continue to grow. As we've discussed in my video in the past, BMO's covered call strategy only covers up to 50% of the portfolio and writes out of the money calls. For ZWT, the moneyness is sometimes as far as 10% out. This leaves a lot of upside for the NAV to climb. Now for ZEQT.T, ZGRO.T, and ZBAL.T, since they don't use covered calls, their targets are all set at 6%. ZEQT is 100% global equities. ZGRO has 20% fixed income, and ZBAL is a 60-40th split. Because these have long histories, the data is trustworthy. ZEQT averages 12.01%, ZGRO is 9.67%, and ZBAL is 7.4%. All of these outperform the 6% target. In fact, for ZEQT.T, the NAV should theoretically grow by 6% annually even after the payout. For ZGRO.T, that growth should be around 3.5%. I know what you're thinking. How do you know they're just returning principal and not selling covered calls? Well, ZGRO.T and ZBAL.T have actually existed for a while. If you compare the performance of the .T versions to the standard versions, they are nearly identical. That confirms it's just returning your capital. Is returning principal bad? Technically, it's labeled as bad rock. But when we evaluate covered call ETFs or non-covered call ETFs, we should always look at total return. Many covered call ETFs with 25% leverage still underperform their underlying assets even with distributions reinvested. In a bull market, a mechanism that avoids capping your upside with covered calls and just returns principal instead is actually more efficient. It might sound counterintuitive, but we have to ask ourselves, do we want the covered call strategy, or do we just want the cash flow? It's just that BMO's.T products show the possibility that cash flow is no longer exclusive to covered call ETFs. So, do covered call ETFs still have a purpose? Absolutely. When prices drop, option premiums provide a buffer. But many modern covered call ETFs use 25% leverage. Does the premium really protect you when leverage is involved? It depends on two scenarios. Scenario 1. A slow decline or sideways market. If we look at the S&P 500 over the last 6 months and compare VFV with USCC and USCL, the covered call versions performed better. Even in a down market, small bounces are converted into premiums. In this environment, the covered call strategy beats simply withdrawing principal from a pure index fund. Scenario 2. A market crash. Let's look at a more extreme example, Bitcoin. In the last 6 months, Bitcoin dropped 40%. The spot ETF, IBIT, dropped 39.38%. But the 25% leveraged versions, HBIX and BCCL, dropped between 42% and 44%, even after accounting for distributions. This proves that during a crash, option premiums aren't enough to offset the damage done by 25% leverage. Interestingly, the non-leveraged BCCC performed the best, down for only 34.78%. However, in my opinion, covered call ETFs still win on distribution consistency. If we compare BMAX and ZGRO.T, which have similar underlying assets, BMAX has never cut its dividend despite having 33% leverage. Meanwhile, ZGRO.T recently cut its distribution by 3% this year, even though its NAV is higher than it was a year ago. BMO's exact logic for these payout adjustments remains a bit of a black box. BMO's target cash flow series is really challenging our traditional view of high-yield investing. We used to think cash flow had to come from option premiums. But BMO is saying, if you want cash flow, we'll give it to you directly without capping your potential growth. So, I'll leave you with this. Would you prefer covered call ETFs? Or would you prefer ZEQT.T with a 6% yield that lets you keep 100% of the market's upside? It's the classic debate. Is it better to take the bird in the hand with option premiums or rely on active withdrawal from a growing portfolio? Let me know what you think in the comments. Are you holding any of these .T units? Or are you planning to? I'd love to hear your strategy. And one last thing before you go. If you want to dive deeper and run these numbers yourself, I've just launched a brand new tool on my website called Asset Explorer. Always welcome to test it out and report to me for any bugs discovered. To be honest, I created this primarily for my own research. I wanted a fast, visual way to check distribution stability and risk metrics. It's been so helpful for my own portfolio that I decided to polish it up and share it with everyone here. Last, if you found my video useful, please hit the like button and subscribe. I'm Oldfish, and I'll see you in the next one.